Hello everyone. So in this video, we'll cover the rates and returns module of quantitative methods for CFA Level 1. Please remember that this is a review lecture, so I will not be tackling any questions or examples in the video. And please remember to watch the full video because somewhere in the video, I'll be dropping a link to download this presentation. This presentation will work as quick revision notes for you guys during the last phase of your preparation. Let's move ahead. We'll be covering the module learning outcome statement wise. There are 5 learning outcomes in this module. So we'll go through each of them individually. The first learning outcome statement is interpret interest rates as required rate of return, discount rate or opportunity cost, and explain an interest rate as the sum of a real risk-free rate and the premiums that compensate investors for bearing distinct types of risk. So let's say an interest rate, it can be thought of in 3 ways. First is as the required rate of return. The required rate of return means the return that the investor anticipates for bearing a particular type of risk or for investing in a risky asset. So that is your required rate of return. The second is as discount rates. So as discount rates, whenever you want to calculate the present value of future cash flows, you discount it at a particular required rate of return. That return is the discount rate. So the interest rates can also be used as discount rates. The third is the opportunity cost. So what do we mean by opportunity cost? Suppose you have got a sum of money, let's say $10,000. Now you have got two options here. First is you can invest it into a risk-free asset or you can spend that money. So if you choose to spend that money, you have foregone the opportunity to earn a risk-free interest on this sum of money. So that is your opportunity cost. Now let's talk about the composition of interest rate. The first component of interest rate is the real risk-free interest rate. The real risk-free interest rate is the interest that you can earn on a risk-free asset, and that is also free from inflation. In a non-inflation environment, the interest rate that you can earn on a risk-free asset, that is your real risk-free interest rate. Then we add the inflation premium into the real risk-free rate. That inflation premium, it compensates the investor for the inflation that is happening in the economy. The third component is default risk premium. Suppose instead of a risk-free asset, you invest in a risky asset. So that risky asset will need to compensate you for that particular credit risk. So that is your default risk premium. The next is maturity premium. So the risk-free asset that you are investing is generally of 1 unit period. That means it could be a 1 year government bond, or it could be 1 month, or it could be a treasury bill. And if you invest in a bond, like in a government bond of 5 years maturity or 10 years maturity, so that means that particular bond is not completely risk-free, because anything can happen in that 5-year period or a 10-year period. So the assets that have a maturity longer than 1 unit of period compensates the investor with maturity premium. And the last premium is liquidity premium. So why liquidity premium is? Because see, the government bonds, they are very liquid. You invest into a government bond, you can sell it at a fair value at any time you want. But if you invest in a illiquid asset, that means like a particular corporate issuer that issues bonds infrequently. So the bonds of that issuer will be illiquid in the market. The supply and demand will be lesser. So if you want to sell a corporate bond with illiquidity, so you will need to be compensated for the liquidity premium. So this is the formula for nominal risk-free interest rate. 1 plus nominal risk-free interest rate is equal to 1 plus the real risk-free interest rate times 1 plus the inflation premium. So this relation is approximately equal. Nominal risk-free interest rate is approximately equal to the sum of real risk-free interest rate and the inflation premium. Now let's talk about the second learning outcome statement. This is calculate and interpret different approaches to return measurement over time and describe their appropriate uses. So we'll be covering different approaches of return measurement. The first is holding period return. This is the return earned by holding an asset for a single specified time period. That means you are calculating the return earned on that particular time period. That time period could be 5 years, 4 years, 3 years, but you are considering that time as a 1 unit. So the return is equal to the ending price minus the beginning price of the asset plus the interest earned on the asset divided by the beginning price. So that is your holding period return. Then let's talk about the arithmetic mean average. The arithmetic mean return is the average return over multiple periods. Suppose you have got n periods and R1 is the return earned in the first period, R2 is the return earned on second period, and so on. So your arithmetic mean return will be the average of all the returns. Then let's talk about the geometric mean return. Geometric mean return is a more accurate presentation of growth in the portfolio, and geometric mean return is calculated as the geometric mean of all the returns minus 1. So that will be your geometric mean return. Then let's talk about the harmonic mean. It's a special type of weighted mean and it is generally used for cost averaging when you are investing into a particular investing a specified amount of money in the same asset but at different prices. Then harmonic mean can be used to determine the average price that you have paid for that particular asset. So this is the formula for harmonic mean. Arithmetic mean, there are some particular points that you need to remember. The first is arithmetic mean is always greater than or equal to the geometric mean. The arithmetic mean assumes that the amount invested in each period is the same, and this is not a practical assumption because suppose you have got $1,000 portfolio and you earn a 5% rate of 5% return on that particular portfolio for for the first month. So at the beginning of the second month, your total portfolio value is $1,050. So the rate of return that you earn in the second period will be the return on $1,050. But the arithmetic mean ignores this practical problem. Geometric mean represents the growth rate or compounded rate of return over multiple time periods. Geometric mean is the more accurate return if you want to compare a particular portfolio return. This is a formula, this is a special relation between these three type of means. The arithmetic mean times the harmonic mean is equal to geometric mean square. You need to remember this formula also. Now let's talk about the outliers. What are outliers? Outliers are the extreme values that you have in your data set. Now there are two methods of handling the outliers. The first is trimmed mean. Trimmed mean removes small defined percentage of the largest and smallest values from the data set before calculating the mean. So that means if you have got like trimmed mean is calculated as remove the 5% of the lowest values and 5% of the highest values, and then calculate the mean of the remaining 90% values. That will be your trimmed mean. And the second approach is Winsorized mean. A Winsorized mean is calculated after replacing the extreme values with their nearest observations. Now let's suppose that you have got a data set ranging from 1 to 100, and your extreme values in that data set are 1, 4, and after that the highest values of your data set are 96 and 99. And in between these values you have got values like 20, 22, 28, 68, 38, and so on. Now we can clearly see that these two values are outliers on the lowest side and these two values are outliers on the higher side. So in the trimmed mean, we'll simply discard these values and calculate the mean of these remaining 7 values. Okay, but in Winsorized mean, what we will do is we'll replace these values. We'll replace these values with the nearest value. The nearest value to these values is 20. So we'll replace 1 and 4 with 20, 20, and then the remaining data set. And on the higher side, we'll replace 96 and 99 with 68. So it will also become 68 and 68. So in the Winsorized mean case, you will be calculating the mean on these values, these all values. That will be your Winsorized mean. Let's talk about the next learning outcome statement. Compare the money weighted and time weighted rates of return and evaluate the performance of portfolios based on these measures. The money weighted return accounts for the money invested and provides the investor with the information on the actual return that they earn on the investment. The mostly used example of money weighted return is the internal rate of return. Internal rate of return is the discount rate at which the sum of present values of cash flows will equal 0. So the internal rate of return, it equates the present value of the cash outflow to the present value of all the cash inflows that you receive from the investment. So that is your internal rate of return. Now the time weighted return, it measures the compounded rate of growth of $1 initially invested in the portfolio over a stated measurement period. The time weighted return is the preferred measure because it removes the effect of cash withdrawals or additions to the portfolio. Your money weighted return is particularly susceptible to the additions or withdrawals from the portfolio. The cash inflows or cash outflows affect the money weighted return. But in case of time weighted return, these additions or withdrawals to the from the portfolio do not affect the rate of return. So time weighted return can be used to compare the performance of two different portfolios, but we cannot use money weighted return to calculate the performance of two different portfolios, to compare the performance of two different portfolios. Now, how to calculate the time weighted return? It's a 3-step process. First of all, price the portfolio immediately prior to any significant cash flow. Break the overall period into sub periods based on the dates of cash inflows and outflows. Then calculate the holding period return on the portfolio for each sub period. Then link or compound holding period returns to obtain an annual rate of return. The time weighted return is a geometric mean of all the sub period returns. The annualized time weighted return is the geometric mean of n returns. So this is the formula for time weighted return. It's similar to the geometric mean return that we calculated before. Next learning outcome statement is calculate and interpret annualized return measures and continuously compounded returns and describe their appropriate uses. So these are some formulas that you need to remember. If you want to calculate the rate of return, a weekly rate of return, and you have got a daily rate of return, what you will do is you will calculate the weekly return in like this, because there are 5 trading days, or we can say working days, per week. So we'll compound the daily rate of return term with 5 times and then calculate the rate of return, weekly rate of return. And if you want to, you have got a annual rate of return and you want to calculate the weekly rate of return, you can calculate it this way, because there are 52 weeks in a year. So these are the different versions of the same formula. This is the generalized form. Annual rate of return is equal to 1 plus periodic rate of return raised to power c minus 1, where c is the number of periods in a year. Let's talk about the continuously compounded return. It is the natural logarithm of the holding period return, or the natural logarithm of the ending value over the beginning value. This is your continuously compounded return, and the value of the portfolio at time t plus 1 is equal to value of the portfolio, beginning value of the portfolio, times exponential raised to rate of return. So you need to remember all these formulas during the exam. Calculate and interpret major return measures and describe their appropriate uses. There are some deductions that affect your return, that the return that you earned on the portfolio. So let's talk about them one by one. First of all, let's talk about the effect of fee. Gross return is the return earned by asset manager prior to deductions for management expenses, taxes, or any other expenses that are not directly related to the generation of returns. But in calculating the gross return, we only deduct the trading expenses because they contribute directly to the return earned by the investment manager. So we only deduct the trading expenses like the bid-ask spread, or the transaction cost. So these are trading expenses, and we deduct that to calculate the gross return earned. The net return is a measure of what the investment vehicle has earned for the investor. What the investor is getting is the net return. It accounts for all the managerial and administrative expenses that reduce the investor's return. The second thing is effect of taxes, the pre-tax or after-tax return. The after-tax return is computed as total return minus any allowances for the taxes on dividends, interest, and realized gains. Taxable investors always evaluate investment managers based on the after-tax nominal returns, because a manager may be earning more pre-tax return, but if he is doing more transactions, the investor will have to pay more taxes, and the after-tax return may be lower than the pre-tax return. Third is effect of inflation. We calculate the nominal versus the real return. So to calculate the real return earned on the portfolio, this is the formula for that. 1 plus real risk-free interest rate, the real risk-free rate that you have earned, times 1 plus the risk premium divided by 1 plus the inflation premium. So we reduce the return earned on the portfolio by the inflation. Real returns are useful in comparing returns across time periods because inflation may vary over time. Real returns are also useful in comparing returns among countries because returns in different countries are expressed in their local currencies. So you need to calculate the real rate of return earned to compare these two returns. The last one is effect of leverage. So how to calculate the effect of leverage? You need to first of all you need to calculate the portfolio return that you have earned, and this is the portfolio return, the rate of return on the portfolio times the equity of the portfolio plus the borrowed funds. So you earned rate of return RP on VE plus VB, and then you need to deduct the borrowing cost of borrowing VB funds. So this is VB, the borrowed funds, times the rate of borrowing. You deduct that and then divided by the portfolio equity. So this is your rate of return for the leveraged portfolio. Now, if rate of return on the portfolio is less than the cost of borrowing, your leverage will actually decrease the rate of return earned on the portfolio. The leverage is only beneficial when the rate of return to be earned on the portfolio is greater than the borrowing cost. So only when RP is greater than RD, that leverage increases the rate of return earned. So this is it for this module. If you liked the video, please hit the subscribe button and share this video as much as possible so that other candidates can also get benefit from this video. I've dropped a link in the description of my Telegram group. Please join that and and you can send any doubts that you have related to CFA Level 1 curriculum. I'll try my best to solve these doubts as quickly as possible. Thank you very much.